Hey everyone, today we're going to talk about taxes. Now, you might be wondering, why are we talking about taxes in the fall? But the reason why, or a couple of reasons actually, talking today will help prepare you now for what's coming down at the end of the year. So we have some opportunities to plan ahead a little bit before 2025 is completely done. And because we have new tax legislation. The new tax legislation that was passed actually will be impacting your 2025 taxes. So it's actually the perfect time to talk about that and maybe some key takeaways from that tax bill that was passed just recently. So today I'm going to talk about just a few takeaways from it. Came up with about 10 things and that should impact somewhere in your life or someone that you know that you can share this with. So basically, we've got the same tax brackets we had before, but we've got a little bit of a twist to it. Beginning in 2026, it will be indexed for inflation, but let's just say you're in the 22% tax bracket. They've widened that out a little bit so that if you get a bump in pay or some raise potentially, it might not be pushing you up into a higher tax bracket like maybe it would have before. So that's one thing that we can look at for 2026 and going forward to consider that, hey, maybe you're not necessarily going to be paying more taxes on that extra, bonus that you got, or if you're working a little bit more. One of the other things here, the second thing, is that the standard deduction's gone up a little bit. So now it's $15,750 for singles or $31,500 for married couples. So more income's going to be shielded, and that should impact pretty much almost everyone across the board right there. The next thing would be that we've got a senior bonus basically now. So for seniors 65 and up, you get an extra $6,000 deduction or $12,000 for married couples. But there are some things to be aware of here. So let's just say you are a higher earner. You make over 150,000 a year in income. Well, that's going to start to phase out that $6,000 per individual. So it's going to help some people out there, but it's going to phase out for people as you start to make more money. The next thing, and this is something you've probably heard a little bit about, is the SALT deduction. So basically, if you live in a state where you're paying a lot of taxes, whether it be for property or state income taxes, that's now jumped from $10,000 to $40,000. It now, unlike some of these other changes that are actually codified and can't be changed, this one only lasts through 2029. So it makes sense to take a look at this and try to bunch those deductions between now and then as much as possible. Number five, the child tax credit gets a boost. So we've got a little bit extra there. It's going from $2,000 to $2,200. So every little bit helps. That's probably the cost of maybe, Christmas for that child. So, or, I'm not totally sure what Christmas gifts are going for these days, but at least helps out a little bit. Moving on, 529s. We've got a little bit more wiggle room there with 529s. So you can use up to $20,000 per year now for K through 12 tuition or even trade schools and certification. So they really tried to expand what you can use 529s for. It used to be a little bit more rigid. People were afraid about putting too much money into a 529 because while it's nice that 529s grow tax deferred and come out tax free for what used to be just higher education expenses, now it's broadened a little bit, and it can be a really good tool to talk about, for other things than just college itself. All right, there are baby starter accounts. So new babies born between 2025 and 2028 get a $1,000 starter savings account. Parents will be able to add $5,000 a year to this until they're age 18, and the funds grow tax deferred and index funds. It's not huge, but it's a creative way to start generational wealth planning. Also, this kind of opens the questions usually for people. When can you start actually opening retirement accounts for your children? And because retirement accounts typically take earned income, require you to have earned income in order to deposit into them. So, like a Roth IRA or a traditional IRA, really they need to be at working age. So, that's something that you can reach out to if you've got some questions on. But it's a question I get quite a bit because a lot of people are real eager to get their kids on track for savings. And I can't stress that enough. Time in the market is more important than timing the market. All right, so giving is getting easier. So if you like to give to charity, the 60% AGI, that stands for adjusted gross income, cap on cash donations is now permanent. And even if you don't itemize, you can deduct up to $2,000 for a married couple starting in 2026. So that's a nice win for people that are looking to give to charities. And number 9, we've got big wins here for some business owners. So if you're a business owner, we've brought back now the full expensing for research and development is back. Bonus depreciation is 100% again, and the qualified business income deduction is now permanent, also sometimes known as QBI. So let's say you're buying some equipment or some software, you can write it off right away instead of having to depreciate it over time. That can really help you in years where maybe you've got some higher income years, but you've also got some large expenses that year. So it can really help level that out and lower your taxes. And then finally, the 10th thing that I've been able to strip away from this here today and talk to you about is around cars. So, similar to what we were talking about before about the 100% depreciation, we're now able to, for a car, you're able to actually now do a full write-off of that vehicle for if it's being used for business purposes. Also, sorry, I kind of stumbled on that one. If you are buying a brand new U.S. assembled car in the years 2025 through 2028, you can deduct up to $10,000 in loan interest. So, that's a really helpful one. And then I guess kind of an add-on here to it's been talked about a little bit, so we'll call this a bonus round takeaway from the most recent tax legislation, is that if you're a tipped worker, so thinking servers, stylists, massage therapists, bartenders, you can deduct up to $25,000 of your tips above the line. So that's a big win for people out there that are working really hard and get a lot of their money through tips. That could also be people that, drive for Uber or do, deliveries and things like that. That's a big source of income for them. So we talked about a lot. There's a lot of different things here, but there's always your situation. And so feel free to reach out to me. Part of what I believe is an important part of your entire investment philosophy and your entire financial plan is tax planning. That's one of the bedrocks of our firm is taking a look at what your taxes are so that you can not just focus on investing what you have, but also making sure you keep what you make. So that's a big part of what we look at. And while some years it might just kind of be a snooze fest, it's really important part of planning as we look ahead. Right now I'm working on some plans for some people that are retiring soon. They have a lot of money tied up into just IRA or 401k money. And that takes a lot of planning to make sure that we distribute that in the most efficient way. So those are the sort of questions that people like to come to me with. I'm always happy to answer them. Tell me what's important to you, and please let me know what your feedback is or questions you have. Thanks so much.